The European Central Bank has kept interest rates on hold, but says it is fully prepared to increase pandemic bond purchases. The central bank has been under pressure to act again just weeks after unveiling a massive €750 billion bond buying scheme. This comes as data shows the Eurozone shrank at a record rate in the first quarter. It suffered a contraction of 3.8% in Q1, the sharpest drop since records began in 1995. On a national level, France has officially fallen into recession, announcing a 5.8% contraction in Q1, while Spain's GDP shrank by 5.2% and Italy registering a 4.7% contraction.
Given the high uncertainty surrounding the ultimate extent of the economic fallout, growth scenarios produced by ECB staff suggest that euro area GDP could fall by between 5 and 12% this year.
And for more, we're joined by Daniele Fraietta, global economist at Fitch Solutions. Daniele, thanks for joining us. So let's start with the latest ECB policy decision. Was it in line with your expectations?
Good evening. Yes. Let me say first that, monetary policy is not going to be a silver bullet. It alone cannot solve supply chain disruptions or stem the spread of the virus or get people back to work. But it can help, and it is helping prevent an excessive tightening of financial conditions. Now, the outcome of today's meeting was largely expected. Alongside forward guidance, the ECB will continue to draw upon its unorthodox monetary toolkit to support economic activity across the Eurozone, because interest rates are the zero lower bound and even below zero if we look at the deposit rate.
And Daniele, with the economy shrinking faster than expected, is it doing enough?
Well, let's say that the ECB has done a good job so far in injecting extra liquidity, cheap liquidity, into the system to shield, at least partially, business and households from a credit crunch. Now, the question is, could it do more if needed? Well, yes, it could. One option could be lifting, for example, self-imposed constraints to its asset purchasing program, such as issue limits. At the moment, the ECB is not allowed to buy more than a third of any single country's eligible debt under the APP program, and this could change. A second option could be and probably will extend the duration of its pandemic emergency purchase program, which is currently scheduled to run until the end of 2020. And it also can increase the size of the program by loosening its collateral requirements, something that the ECB did already, at least partially in mid-March, when it said that it would accept fallen angels as collateral from banks. So bonds that have lost their investment grade rating, provided that they had an investment grade rating on April 7. But the ECB could go even and farther than that, and will probably go even farther than that. It can start buying fallen angels outright, following in the footsteps of the US Federal Reserve.
Okay, you mentioned that it's not a silver bullet, saying all that it's a tightening of financial conditions. So on a national level, which economies are likely to be hardest hit then?
Well, okay. The Eurozone as a whole, according to our forecast, is going to contract by around 6% in 2020. But let me stress the fact that our forecasts are very fluid, in flux, and risks to our forecast remain to the downside. The hardest hit economy at the moment is going to be Italy. We are forecasting a contraction of almost 14% in 2020. Then Italy will be followed by France, minus 8.6%, and Spain, minus 7.5%. The common denominator of the recession across countries will be a rise in unemployment, which will be one of the main drivers behind a sharp contraction in domestic demand. Consumers will spend less, companies will invest less. Also, tourism revenues will be hardly hit, and tourism revenues account for a sizable chunk of GDP. Public spending will increase, but looser monetary policy also enough to offset a sharp contraction in consumption and investment activity. But again, risks remain highly skewed on the downside.
All right, thanks for your analysis there. We've been speaking to Daniele Fraietta, global economist at Fitch Solutions.